Markets are supposed to be rational. That's the promise. Prices reflect information. Millions of independent decisions, filtered through data, discipline, and logic, somehow converge on truth. It's a comforting idea, especially if your money depends on it. But history tells a different story. Again and again, markets have moved before the numbers arrived, before profits, before revenues, before proof. Prices surged, collapsed, reshaped lives. Not because spreadsheets changed, but because a story took hold. A story that felt inevitable. Welcome to The Financial Historian, where money, power, and history collide, and where nothing is ever as simple as it looks. If you want to understand markets, stop asking what people know and start asking what they believe. For most of financial history, markets didn't run on data because data barely existed. There were no earnings calls, no GDP releases, no inflation dashboards, no central bankers explaining themselves in carefully rehearsed language. Information moved slowly, unevenly, often unreliably. A letter might take weeks to arrive. A newspaper might already be outdated by the time the ink dried. But a rumor could cross an entire city in a single afternoon. So belief wasn't a distortion of the market. It was the market. Prices weren't discovered through analysis. They were narrated, shaped by repetition, confidence, and social proof. The more a story was told, the more real it felt, and the more real it felt, the more money followed. To understand this, imagine how markets were actually experienced. Picture a crowded street in 19th century Britain, a newspaper vendor shouting headlines, a pamphlet promising opportunity, a neighbor leaning in close, lowering his voice. "Everyone's buying," he says. "I already did. You don't want to miss this." There's no balance sheet to check, no historical data to study, just the feeling that something big is happening and that standing still might be the riskiest choice of all. By the time the numbers arrive, the decision has already been made. This is why stories matter more than facts during uncertainty. Facts require patience, stories offer clarity, and when the future is unclear, clarity is priceless. Let's make this concrete. Meet Edward Harrington. Edward is a clerk in London in the 1840s. Careful, respectable, not a gambler. He's heard about railways for years. Iron tracks slicing across the countryside, shrinking travel from days to hours. Everyone says the same thing. This will change everything. Newspapers celebrate every railway approved by Parliament. Prospectuses promise steady, guaranteed returns. Politicians call railways the destiny of the nation. Edward doesn't understand engineering. He's never seen a locomotive up close, but he understands inevitability. How could something so transformative not make money? So, Edward invests, and so do thousands like him. This moment became known as Railway Mania. And here's the key detail most people miss. The story wasn't wrong. Railways did change the world. They unified markets, lowered costs, transformed economies. The mistake wasn't believing in the future. The mistake was paying any price for it. Too much capital chased too few viable routes. Expectations sprinted far ahead of cash flows. When revenues failed to match the story, prices collapsed. Fortunes evaporated. Lives were altered. The railways remained. The belief didn't. The lesson wasn't that the story was false. It was that inevitability is not the same thing as valuation. Markets don't punish incorrect narratives. They punish mistimed ones. Decades later, the same pattern reappeared, this time under the Florida sun. In the 1920s, Florida was sold as a dream. Endless sunshine, limitless growth, a permanent stream of new buyers arriving tomorrow. Land prices soared, not because the land suddenly became more useful, but because buyers believed there would always be another buyer behind them. Plots were purchased sight unseen, sometimes underwater, sometimes inaccessible. The mechanism wasn't analysis, it was momentum. As long as the belief held, prices rose. Then transportation bottlenecks hit, hurricanes struck, new buyers slowed, and suddenly the story cracked. Prices didn't gently adjust, they collapsed. Florida didn't disappear, the sun didn't stop shining. What vanished was the shared belief that prices could only go up. Markets don't need reality to change, they need belief to change. Sometimes, though, markets don't collapse because a story proves false. They collapse because confidence snaps. That's what happened on October 19, 1987, Black Monday. Global stock markets fell more than 20% in a single day, one of the largest one-day declines in history. And here's the uncomfortable truth. There was no sudden economic catastrophe, no earnings collapse, no war, no mass default. What changed was perception. Selling triggered more selling, fear fed on itself. Automated trading systems amplified moves humans were already panicking about. Investors stopped asking, "Is this asset still valuable?" They started asking, "Is everyone else about to sell?" And once that question dominates, price becomes secondary. The market didn't crash because the economy broke. The economy survived because the crash stopped. Black Monday exposed something essential. Markets aren't fragile because assets lack value. They're fragile because belief is reflexive. When people believe others will panic, panicking becomes rational. Fast forward to the digital age. The structure hasn't changed, only the speed has. Initial coin offerings didn't invent speculation, they removed friction. Stories that once took months to spread now travel globally in minutes. Forums, social media, comment sections. Belief can now be manufactured, reinforced, and simulated at scale. When dozens of comments appear praising the same token, predicting the same outcome, repeating the same phrases, it feels like consensus. Often it isn't, it's coordination. Artificial confidence still produces real price movement, at least temporarily. Markets respond to signals, not intentions. This isn't a failure of intelligence, it's human psychology. We're social creatures navigating uncertainty. We look to others for cues. We assume repetition implies truth. We confuse confidence with insight. Markets don't run on information. They run on shared expectations of reality. By the time modern markets react, belief has already done the work. That's why a single sentence from an authority figure can move billions of dollars. A tweet, a speech, a phrase like data dependent or soft landing. Forward guidance isn't data, it's narrative management. Sometimes it stabilizes belief, sometimes it buys time, sometimes it fails spectacularly. Because belief can be guided, but never controlled forever. Here's where it becomes dangerous. When markets move on stories, people stop asking whether something is true and start asking whether other people will believe it. Value becomes secondary. Fundamentals take a back seat. Risk stops looking like risk because everyone else looks comfortable. This is how bubbles form, not from stupidity, but from plausible stories that arrive early and priced late. Railways were real. Florida did grow. Blockchain is transformative. The danger was never the idea, it was the price paid for belief. So what actually protects you? Not ignoring stories, that's impossible. The real skill is distinguishing narrative from structure. Narratives tell you what people are excited about. Structure tells you where cash flows, incentives, and power actually sit. When those align, momentum can last. When they diverge, corrections are brutal. History doesn't repeat, but belief rhymes. And every time belief outruns reality, markets collect the difference from whoever arrives last. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.